Hello and welcome.
I totally
Joining us
forgot.
live again.
No.
Hey, what did I forget?
Hey, no, I forgot. Carry on.
You got two
Carry
down.
on.
You got two lost in the sauce again.
Mm-hmm.
Oh my God, it's happened all over again. Hello and welcome. You're joining us live for the Investor Lab, the epicenter for passionate people seeking a life of freedom, choice, and abundance. And we are back after a 2-week hiatus. 2 weeks. Feels like an eternity. It feels like an absolute eternity. It feels like a very long time since we have been here with you live. We're very excited to be with you here live. If you are here, let us know in the chat. We'd love to see you here. We'd love to see you live. So we had obviously we had Easter off, and then Gabby and I both got sick, and then we had to take another week off. But it feels like, so now it feels like we've been away for so long. But we're super excited to be back. Gabby, how are you going?
I'm good, man. I feel fresh. I've still got a bit of the sniffles, so if that comes through, that's what's going on. Yeah, it has felt like a long time. Like even, I'm forgetting to do the bloody music fade out. I'm forgetting what I'm doing. We've been doing it a while, but I'm forgetting what I'm doing.
Yeah, you've got island mind. We'll call it that. So
like
for those
it'll
of you,
work out. It'll work out.
Yeah. It's like island time, but for the brain, basically.
Yes.
Exactly. So for those of you who are wondering, we are on a tiny little tropical island right now called Koh Phangan. It's where we've been for the last 2 weeks. If you haven't been here, definitely come here and check it out, or don't, because then there's more room for us.
Stay away.
For those of you who don't know, Koh Phangan is kind of like what Bali was about like 20 years ago, or probably what a lot of people think Bali would be like. But yeah, it's a beautiful little island.
It's beautiful.
So we're very, very privileged to be here, to be able to spend some time here and spend some time here with you. And I'm really excited about today's episode. Gabby, are you excited about today's episode?
Always. I'm excited because we have one of our favorite people, Mr. Jeremy Iannuzzelli, who is sitting in the waiting room. I just thought we'd have a little chat with Goose and I because we haven't done this in a couple of weeks, and we thought we'd say hi before we bring Jeremy on. But Jeremy, I'm going to bring you on now. Hello.
How are we going, guys?
Good afternoon.
Hey, Jeremy, great to see you. How are you?
Very well, and I'll reciprocate the feelings, Gabby. You guys are my favorite people online as well.
Oh, thank you.
If there's anyone who brings the energy to property and investing, it's definitely you two combined.
Thanks, man. Thanks. It's good to see you. We haven't caught up in a little while, so I'm excited to dig into stuff today. But just for the benefit of everyone who doesn't know who you are, why don't you give us the kind of like 30-second background? Who are you? What are you doing? You've obviously got your podcast that you've been doing recently. What they should have taught you in school. Give us a bit of a loop in before we get stuck into the episode.
Yeah, so I've been an accountant now for 18 years, an investor for that period of time, and built up a large property portfolio and manage a number of property professionals and investors. So I'm very lucky that I get paid to learn every day and get to see where things are, what's happening, what people are doing, and get to work with many of your mutual clients as well, which is always a pleasure. But What School Should Have Taught You is a new podcast that I've started, and it's in that top 50 business podcasts in Australia now. And
awesome,
it's my version of writing a book. I tried many, many years to write a book and failed and got through a couple sentences before I gave up. And the new way of getting your message out now is a video, and I love doing it. It's a passion, and it's everything about finance, everything you guys need to start with today so you can be quite successful in the future, and just things that I got and took advantage as a young kid, being around the table, listening to my father speak. I now get to share that with people, and yeah, there's lots of community being built off the back of it, and hopefully lots of wealth in the future to come as well.
Nice. Very exciting.
Beautiful.
Well, we are lucky enough to have you as our personal accountant. You've obviously worked with plenty of our clients. And so we've had the privilege of getting to know you very well over the last several years. What's interesting about your particular point of view and particular positioning is that you're a very successful property investor in your own right. So you've got a pretty significant property portfolio. I don't know if you want to speak to the size of that. But let me ask you a question as well. What came first, accounting or property investing? Did you start accounting because you started property investing, or did you start property investing because you started accounting?
I 100% started property investing because I started accounting. I was a young kid in the industry, and I was looking at people who had 4, 5, 6 properties in a portfolio and thought that was unreal. I actually thought it was unattainable, to be fair. And then the more and more people I started to see who had large portfolios and built wealth, and just the financial freedom that they had, that pushed me to become a property investor. And now I'm one of those people pushing other people to do the same.
Nice, very good. And over the years, you built a pretty significant portfolio. Do you want to speak to that a little bit? Because
absolutely.
Because I want to dig into some of the secrets of how you got there today. That's what kind of why I want to reference it.
Yeah, so today there's 23 properties in the portfolio, and that will fluctuate depending on what I'm buying and selling at the time. Value will fluctuate as well, but last market valuation was about $25 million in property. So done very well, and we've all got to share in the benefit of a great COVID pandemic boom in the property cycle. But that's where things are sitting today, and it will fluctuate depending on market and also what I'm doing at the time.
Yeah, awesome. So that's a good setup. Now, the reason I wanted to bring that in, because I'm not big on ego metrics. Like, I don't really care. Like, the whole I've bought 50 properties or whatever. Like I don't care. Ego metrics are not actually really something that interests me a lot. The reason I thought that was a relevant point to make, though, is because you've walked the path in a very significant way. So you've had to actually work out, okay, what is required in order to get to a portfolio of 20 plus properties. And, from my observations, and I'm sure from your observations as well, it's very hard to do that without the incorporation of things like trusts and structuring and all that kind of stuff. Aside from someone who's potentially exceptionally wealthy, I don't know that you could even do it in your personal name. I think you would run into a limit, but unless you're really, really, really wealthy, unless you're very, very wealthy, you have to integrate strategically, thinking about things about how you incorporate things like your SMSF. How does that fit into your portfolio? Discretionary trust, all of that kind of stuff. And that's actually what I really want to dig into today, because we get a lot of questions about that. Now, I remember when we sort of started, when we started Dashdot in 2019, we didn't know anything about that. And it was around 2020 where we started to really get an understanding of how trust played a role in portfolios. What I've seen since then, because when we started talking about it, not many people were talking about it. I'm not suggesting for a moment that we discovered gold. Like, we learned from other people, but at that time, that was not a commonly spoken about topic. Now it's sort of the idea has crossed the Rubicon, but I think it's actually done so in a way that has actually caused people to start to misunderstand it. Now it just sort of seems like everyone's just like, oh, trusts are the magic solution to infinite borrowing and all of this kind of stuff. And actually, people are lacking the intellectual substrate to understand how they work and how to integrate them into your portfolio and how to think about them strategically. So I think a lot more people understand the concept of we should invest in trusts or use trusts as part of our strategy, but they don't actually get how and why and when to and when not to. Now, obviously, there's a lot of stuff that we are not able to talk about because we don't have the same licensing that you do. And so what I want to do today is I want to grab everything that you know and everything that we know and bring it all out onto the table and help people to understand better how to use trust and structuring, whether it be SMSFs or whether it be discretionary trusts or any other type of thing, to navigate building a successful, profitable property portfolio. How does that sound to you, Jeremy?
Yeah, fantastic. And I think we can definitely say you and I were probably one of the first people to discuss it. So I know that, across many platforms, many people still reference the discussion you and I had nearly 5 years ago about it. So it's good to see that that's still running around and lots of people are learning. But I think you articulated it really, really well. There's a lot of intricacies around when structuring, when to structure and how to make it work. And there's a lot of misconceptions. There's a lot of people out there just throwing it as a structure for infinite borrowing. And yes, it can have those capabilities under certain circumstances, but for a large portion of Australian investors, it's not going to provide infinite borrowing from day dot. It is part of a property plan. And I get to be involved in a lot of the property plans that you guys do at Dashdot. And it's a plan that's over 5 and 10 and even 15 years of a consistent approach of buying property. And I think that's one of the big things that many investors don't understand. They think that it's a get-rich-quick scheme. You buy 5 properties in 2 months and you've got endless amounts of purchasing power off that. It's not, and it never has been. My purchasing journey has been and has come through windows of opportunity. So when there's a great time to buy, I may buy 5 or 6 in that 1 year, and it may be 3 years where I consolidate and I save and I build up capital and wait for borrowing conditions to change. During that low interest rate environment, it was a great structure for people to propel themselves into more properties through the use of passive income that the properties would be providing if they were to buy in a trust. But we're not in 2% interest rates anymore. We're in much more normal interest rates of high 5s and 6s in some circumstances, and even 7s, depending on which bank you're going with. And that means you need to be very sophisticated with the approach of how you finance and how you structure your properties, but also take a very long view to say that rates won't stay this high forever. And we're doing it today for the seeds that will get the benefit and sow, 3 or 4 years from now.
I think it's such a good point because, as environments change, so does your point of view and so does your strategy and so does your perspective and all of that kind of stuff. And, we have never been a proponent of negative gearing, particularly as a strategy, right? So we've never, for a very long period of time, our kind of catch cry was cash flow positive properties in high growth areas. But what changed is interest rates went up, and in a very pragmatic sense, yes, you can still find cash flow positive properties, but are they from our perspective, we haven't been able to do that successfully and also have them strategically aligned with actually being the right purchase, right? So just buying a property because it's cash flow positive isn't a strategy, just in the same way that chasing negative gearing just for the tax benefits isn't a strategy, right? These are things that kind of factor into a broader idea of building a portfolio. But, it's interesting because, with interest rates going up, that has changed the dynamic of property in Australia. That does mean that for most people using borrowing to buy properties, they are going to be cash flow negative. It doesn't, not necessarily dramatically, but at least to at least some degree, going to be cash flow negative versus cash flow positive, particularly in the first couple of years. And so, that has caused certainly myself and broadly Dashdot as an organization to revisit how we think about some of these things, how we think about the conversation around negative gearing, and how we think about things like, well, when is a trust an appropriate thing to include, and how do you think about this? Because a lot of people are really struggling with a cost of living crisis, and they're thinking, okay, I want to invest. In fact, one of the things that I've noticed, Jeremy, and maybe you've got a point of view on this as well, is that as the cost of living crisis has gotten worse, people have started to realize more and more that investing is no longer an option. It's actually starting to become a necessity if they ever want to get out of the muck, if they ever want to create financial freedom. So it's now actually, it's this interesting kind of inverse correlation where it's gotten harder, and that's actually made people really recognize that they have to invest even more. The challenge though, is that, if we go back a few years when we had 2% interest rates and stuff like that, it was fairly easy to get cash flow positive properties, right? And you could get that with good growth. And the context, and we should probably unpack this a little bit more in case people are hearing it for the first time, but the very, very, very oversimplified format of the context of using trusts is that if you invest in a trust and the trust is cash flow positive or profitable, then you can silo the debt, to use a kind of very simplified term, and that can potentially give the opportunity to get more loans and get more borrowing. But if the properties are cash flow negative, then that significantly changes that perspective. You have to then take a consideration and ask yourself, are you better off buying in your personal name to claim the negative gearing tax benefits, or are you better off buying in a trust? How do you think about that? What are your kind of thoughts around that topic?
Yes, it's a bit of a strategy. There's always methodology behind everything that we do. And I talk about this comment being a path to positive. And we look at broadly property investing not being for 6 months or 2 years or 3 years. Sometimes we like to look at it over a 5, 10 year or 20 plus year horizon, at least a 2 or 3 property cycle horizon. So if we're looking at properties where there's a good path to being positive, we bought a property where the goal is to build a granny flat on it in the very near future, and that combined level of yield between the two dwellings will produce a positive income by year 2 or year 3, well, then that's a sacrifice that I would make today on negative gearing for the benefit of being able to negate that debt in the future. For a lot of the clients I talk to, and especially for you or anyone buying 1 or 2 properties initially, I really love to keep things quite simple and try to obtain the negative gearing if there is negative gearing there due to the expenses being more than the income. I always argue to say buy those first couple in your own name. Why? You want to keep the costs low, you want to keep the lending simple, you want to keep the overall, scenario, tax, managing the properties as simple as you can. As you grow and your income grows and rates may come down, your borrowing capacity will improve. What it looks like today is not what it will be in the future. So we like to look at the investment itself as its own asset, its own little business, what are the factors, what are the trigger points, what are things that we can ignite in the property to improve its position from a capital and rental perspective. If there's not a lot there and we're buying it very much as a foundational asset to get into the market, and we've got a really good long horizon where we can own it and it will be positive after 10 or 15 years, I would argue to say buy that personally. So they're the couple of things that you need to consider when initially looking in portfolio.
Can I just challenge that a little bit? And I'm deliberately going to be a little bit provocative in today's episode, Jerry, because I just want to challenge some of the thinking around this, because I'm going to just talk about accountants broadly, right? So accountants broadly tend to have a bias when someone goes to speak to their accountant to just say buy in the personal name, particularly for the first one or two. And I think I understand why. It's because 90% of property investors never buy more than one or two properties. And so if you're never going to buy more than one or two properties, then yeah, probably don't overcomplicate things. However, if there's a scenario where someone is really committed to building a significant property portfolio and they're willing to sacrifice the short-term benefits of negative gearing, can it make sense actually to like if they know in their mind's eye that they're really committed to building a 5, 6, 7 a 10 property portfolio, does it actually make more sense for them to just bite the bullet and start investing using trusts from the get-go so they have the right structure in place? Because part of the reason I ask that is, I know plenty of people who've built property portfolios at 6, 7, 8, 9, 10 properties, and every single one of them bought at least the first property in their personal name, and every single one of them has had to go back and sell that property later on. They've made money from it, right? All good. But they go back and they sell it, and then they go, man, if I knew what I knew now, I would have just invested in a trust from the get-go. So how do you rationalize that challenge?
Yeah, it's a really great question, because it's all about making sure that the trade-offs all have a benefit towards the end. In saying that, we like to look at the person's individual circumstances. So if they're on a very low income and, or not a very low income, medium income, they might have a wife and a child, and there's really very little scope that they can foresee to have massive or drastic changes from a financial perspective, you might find that going in a trust for them very early on may not be beneficial, and the cost, maybe land tax or cost of the compliance and cost of the structure, may outweigh their future benefit. But if you've got, very committed clients and they've got a really good path and trajectory upwards and they've got really good income trajectory as well, then absolutely, they're the things that we take into consideration and may structure early on to be in, say, for instance, a trust with a corporate trustee. But that business plan to the property also becomes very important. So if that first person's property, for argument's sake, is a Bondi apartment worth $2 million, renting for $1,000 a week, it's going to take a hell of a lot of capital and a hell of a lot of time to bring that in a positive position, and potentially some land tax in the trust that someone needs to pay because there's no threshold in New South Wales. So there are a lot of things, Goose, that go into making that decision. There's a lot of understanding around the business plan of the property that they're buying and making sure that it does have that path to being positive in the future, together with their income trajectory and financial habits. There are circumstances where I have done trust very early on, and there are circumstances where I've said, look, it's probably not the right thing for you to do just yet. But when we get to that property number, maybe 2 or even number 3, that's when we consider the corporate structure. That's when I know you're committed. You've now shown me not, and that cost versus benefit analysis has been done, and the benefit will outweigh potentially what the cost will be if we go into a structure early on. So there are a lot of things. There's no one rule, but I'd like to not sit on the fence as much. And I do like to say, those first maybe 1 or 2 properties we buy, as a bit of a blanket rule, subject to circumstances, we probably like to do it individually, because a lot of people who might be buying their first or second property normally would be a lot younger, say below the age of 30, and they're nowhere near their peak as far as their career is concerned. So I know just statistically that they've got a really good horizon ahead of them, lots of income they'll earn, and their borrowing capacity constraints of today will not be the same in, say, 2 or 3 years' time.
Yeah, it's super interesting. And my understanding from a conversation I had recently with actually our head of finance at Dash.Finance is that the trusts don't actually need to be in 100% profit for you to be able to benefit from some of the debt siloing kind of effects that you can get. Now, I want to talk about land tax and stuff as well, because it's very, very important. Trusts are not just a blanket, panacea for all of the woes of property investors, right? But my understanding up until fairly recently was that the trust itself had to be profitable. Now, one question is it cash flow positive, or is it an accounting profit? Right, that's one question I've got. But then also, I was talking to Callum, our head of finance at Dash Finance, and he was saying that some lenders, you don't actually even need it to be 100% cash flow positive. They'll just take the difference. So let's say it's $5,000 cash flow negative. The balance, say the $5,000 cash flow negative, they'll just see that as an expense on your personal income versus the whole debt that's captured in the trust. So you're still getting some benefit. So let's say you've got a $500,000 debt inside a trust, but it's $500,000 debt, and let's say it's $5,000 cash flow negative. Depending on the lender won't be looking at the $500,000 debt. It'll be looking at the $5,000 cash flow negative and saying, okay, well, you earn 150 grand a year and you got a $5,000 expense, so we'll knock $5,000 off your income, basically. Is that how you understand it too?
Yeah, absolutely. So it's the deficiency, which they're taking as cost, as part of your HEMS, your living costs, and that borrowing capacity deficiency of that $5,000 in your example might only reduce their borrowing capacity by $40,000 or $50,000 or $100,000 compared to the borrowing that's in the trust. So yes, there are some banks that are doing it. Now, I like to use cash flow profits because depreciation is a non-cash expense. We're getting that deduction as part of the original purchase, or there may have been some renovations as part of the purchase that's been done. So I like to assess with depreciation being added back because it is a non-cash deduction. So that's one thing out there for everybody listening. More importantly, Goose and Gabi, what some banks are doing, not all, but there's a very small handful, is that they're actually now giving clients the opportunity of doing what they call a self-declaration letter. So bypassing the accountant altogether, and as long as you self-declare that entity is positively geared, it gives you an opportunity of being able to negate that debt and now borrow in a new entity with that new bank. So there's a lot. What we are seeing when things are slowing down because interest rates are higher and number of loans and value of loans is reducing, the banks are a business, and we've got some of the healthiest banks in the world. I believe last time I read, Commonwealth Bank sits in number 4 or 5 most profitable bank in the whole world. And it's only really lending to 15 million Australians. So, and that's due to our variable interest rate environment, where a lot of banks around the world charge fixed rates, even though the variable rates would be much higher. So we do sit in some of the healthiest banks in the world. We've got a very strong banking system, a very regulated banking system. So they have some flexibility of being able to change internal policy to keep people borrowing, but obviously done in prudent ways to not recklessly lend money and thus have a GFC 2.0.
That's really fascinating though, because in a debt-based monetary system, the act of issuing credit creates more money, creates more liquidity in the system. Liquidity flows into asset prices and drives up property prices, right? So like their willingness to find new ways to make sure that they can extend credit is actually a direct linkage to the amount of liquidity flowing around in the economy, and the direct linkage to the property market growing in and of itself. So it starts to become a self-fulfilling prophecy.
Well, it's always been, Australia's always had a very healthy property economy, which means that we've always had a very healthy internal economy. People feel confident with prices going up. And that's one of the things I heard with the recent election debates that are going on. And a lot of the commentary is that we don't want to crash the property market. We want to have a sustainable property market. And the sentence is very simple. A healthy property market is a healthy Australia. We are a society. We are a culture. In fact, the only culture in the world that probably places such a heavy emphasis on property and property wealth, where if you look at a lot of the other emerging nations, they look at business owners and business wealth as a measure of success, where in Australia, it's our measure of success is based upon the property portfolio that you're holding.
Yeah, it's so interesting because I've actually spent a lot of time looking at international markets just to see what opportunities there are, both for ourselves and for our clients. And the Australian residential real estate market, specifically the Australian residential real estate market, is by far and away the best real estate market on the planet. And that's partly because of this, macro cultural point of view that gets supported not only by government policies, but banking policies, RBA policy. Like, there's this constant reinforcement loop to make sure that the property market continues to grow. And therefore it does continue to grow. And it's a fantastic market. I haven't seen anything else like it.
We're strongest in the world. And we're a very big country. And to see a majority of all of our capital cities all sharing in that strength, it just goes to show that we've got a very healthy cycle ahead of us over the next 10 years.
Yeah, I want to come back to structures, but I also just want to ask you, just while we're on this theme, because the value point of view, you mentioned earlier, you believe that we're at the start of a. I'm paraphrasing, but you said over the medium term you expect rates to come down, or over the long term you expect rates to come down. What's your point of view on that?
Yeah, absolutely. I do believe that the rates coming down are already baked into the market, into the economy already. Now, that's backed by all the major banks and even a lot of the second and third tier lenders as well. There's a lot of pricing wars going on, a lot of interest rate reductions, especially anyone listening. Again, if you want to call up your banks and have a bit of a chat with them about reducing the interest rates, they're actually more welcome to it than they were about 12 to 18 months ago with the uncertainty of where rates would land. So we definitely will see liquidity ease up again. Goose and Gabi, I've seen so many of my clients on the sideline waiting for interest rates to come down. Very two-tone property economy. A lot of legacy investors have been investing for quite a while, have sold down some of their portfolio to restructure some debt, to debt reduce, deleverage, sitting on lots of cash at the moment, waiting for an opportunity to go back into the market when their borrowing capacity frees up. There's a lot of debt equity still in a lot of people's portfolios, things that they can see, but they can't necessarily extract the value. And on the other side, we've seen a lot of new entrants into the market who have been able to borrow during a period of time where interest rates have been higher, and they've been able to meet the market because there hasn't been a huge supply of investors and a huge demand that was driven by very low interest rates, say, for instance, like the COVID pandemic. So we've got a lot of money and there is a lot of capital sloshing around the system still, Goose and Gabi, and I think there is going to be a bit of a run. It may not be a heavily sustained run, but there's going to be a bit of a frantic pace movement towards properties as we start to see rates come down.
What's your point of view on that kind of like time? I'll tell you my point of view. My point of view is we're moving into a 24-month easing cycle. Now I have the way that I got to that is, I looked at average bond maturity rates. I looked at a whole bunch of stuff and went, okay, if there's, because, governments have got to refinance debts, rates are going to come down, all of that kind of stuff. I think on the macro, rates will normalize at a lower level, probably something like 3s and 2s or somewhere around there. I think that's probably where they're going to end up sitting, is around 2s and 3s. But I actually think that there's probably going to be a bit of a slingshot effect where we go down and then it's kind of bounce back up a little bit and kind of oscillate around. But I think over the next 24 months, we have a general easing cycle, and that's going to create some sustained interest in the property market. And to your point, there's a lot of capital sloshing around, looking for a home that's kind of waiting for these opportunities, which then says to me that if you want to front run the opportunity, like now's the time, personally. But what's your kind of point of view on sort of a time scale for this? Do you think this is going to be do you share the same sort of point of view that we're going to come down and then normalize at a lower rate for longer? Or do you think we're going to go through an easing cycle and then back up? What's your kind of...
Yeah, I think I always like to call it the tennis ball approach, and that's how typically they work. So when they go up, they kind of go up and it just slingshots like a ladder. But as they come down, think of like a tennis ball dropping on the floor. It first drops really fast and then it rebounds up a little bit and then goes down again, rebounds up a little bit more, and then it kind of finds its space on the floor. And I think that's what we'll see from the RBA. We may see some consecutive rate cuts, a bit of a holding pattern. If things are reacting the way they want it, they may drop it slowly again. If it's not, and inflation starts to kick off again, and historically, that's what typically happens during inflationary times. Rates go up very quickly. They come down. They overshoot the mark. They've got to go up a little bit to stabilize it again before they come back down to level everything out. So I actually don't disagree with your philosophy and your thoughts, Goose. I actually think you're very much spot on. We will see a 24-month easing cycle of rates before they level out to where the RBA will see they're confident. Only thing I would suggest is those rates may go down a bit quicker, may level out a bit quicker, and that's all dependent on the Chinese economy very openly. At the moment, the tariff war that's going on between China and America, the two biggest trading partners in the whole world, that is kind of causing a lot of concern for many economies, especially Australia, who, believe it or not, we feed the beast that then sends the products to America. So if we're not able to feed the Chinese economy with our raw materials, which they then manufacture and then flick over to America, if they can't be nimble enough to find other markets, then there may be a quicker slowdown here in Australia off the back of our reduced raw material exporting sector. And Jim Chalmers, the current treasurer of Australia, has noted that, and he's gone and flown to China a couple of times and had chats. So I think they know what's going to go on in the background. It's just whether it gets to us being the consumer quick enough so we can make really informed decisions.
Let's talk about that. I mean, we're here to talk about structures, but man, there's some interesting shit going on here. Let's follow where we're going. So my point of view on this is that every scenario that plays out with China is deflationary for Australia, basically.
Absolutely.
Right? So, yeah, fascinating that you agree. The last episode we did, which was 2 weeks ago, because we were off the last 2 weeks, was specifically on this. We did like a nearly 2-hour episode, I think it was, specifically on tariffs and the impact. And basically, the US is trying to devalue the US dollar to bring the Dixie down. China's impact is either they're shut out of the US market, which they still are. Therefore, they have to dump their goods on Australia and Europe, but also Australia. So therefore, we're going to get cheaper goods. That's going to drive down inflation. But also there'll be less exports. So that's going to drive down production, which is going to weaken the economy, which is going to cause a weaker economy, which is going to cause deflation. So everything points to deflation. And then the government's response to deflation, because governments can't handle deflation, is going to be money printing or easing, or there's going to be monetary easing. However, whatever mechanism they choose out of their basket of tools, but there'll be increases in liquidity and liquidity flows. That's going to flow into the property market. So the only outcome I see is, no matter which way you cut the cake, it looks like deflation for Australia, which means increased liquidity to offset the deflation, which means property market goes up. You agree?
Absolutely, yeah, and people, I wouldn't change the word. I'm getting debates with people saying, how is it not inflationary? Well, it's very simple. As you said, China's got over 1 billion people that they need to feed, and they're a manufacturing powerhouse. They still need to manufacture. They need to keep people busy. Now, contrary to what people might think, China is a communist country, and if people aren't busy and they're not being fed, you'll get political uprising. So they're going to continue to produce, and that means they've got to find a market to sell those goods in. And it may not be at the most profit that they were getting before, but they'll be at some profit. And for Australia, we're very close trading partner with China, and we're already starting to see some of their products. And I know firsthand, I've got some people that I know that work in private sector of banking systems like UBS and other stuff like that. There were literally ships that were on the way to America during the tariff war that were stopped, turned around, and were actually being told to either go to India or Australia. And we will be receiving those products at a heavily discounted.
Yeah, that's fascinating. It's fascinating, right?
Again, deflationary, and as
oh no,
Jeremy's breaking up. Jeremy, you're breaking up a little bit there.
I'm sorry, I'm here.
No, that's okay. It's all good. I think you're back now. It's interesting, right? Because just
back again. So as you were saying before, it will resolve.
We've got a little bit of a lag.
Apologies.
We've got a little bit of a lag.
I think I'll say there we go. So I was saying before that it will result in deflationary. You're right.
Sydney.
Increase.
Sydney.
Is it raining in Sydney?
Yeah, that's the big question. All right, when Jeremy's comes back, we can ask him if it's raining in Sydney, if that's what's happened to the internet. So I was thinking about this China deflation thing a little bit, Gabby, just whilst we're on the topic, and I think that the US is 18% of China's export market. So if you just kind of think about that very broadly, they've got 18% of their goods need to go somewhere, and they're going to be discounted by about 18%. But very roughly.
I might be here if this is still live. I'm here by myself, waiting for the connection to return.
We are still live, Jeremy.
There we go.
We can hear you.
I was there by myself, waiting for the connection to return.
That's okay. Is it raining in Sydney today?
No, it's not. No, my internet's all fine actually.
Wow.
So not sure what's going on.
That's okay. That's right.
While we've got some good bandwidth, we'll continue on.
We'll keep going. Let's swing the conversation back to trust and structuring, because I've got a whole bunch of questions in and around this. I want to get to some CGT stuff, some distribution stuff. I want to get into some kind of media kind of technical stuff. But why don't we just take a little bit of a step back? And if someone is listening to this for the first time, and can we just do a short primer on why would you invest in trusts? when is it appropriate, and what are some of the key considerations? We don't have to do an encyclopedic review, but just kind of like an overview of why. Like, why would we do it?
Yep, brilliant. So nice 3 easy quick tips. So number one, it gives us really good asset protection. So anybody who is running a business or may be exposed to some risk, a trust is an entity that you control but do not own. So there's your asset protection benefits. Second is tax minimization, the ability, and as investors, we're all investing for a profit. We don't invest for prolonged losses. So it's the ability to be able to distribute profits in the long term to the beneficiaries to be able to minimize tax. And those beneficiaries can be real human beings or corporate beneficiaries, otherwise known as profit holding entities or bucket companies. So trusts are a really good way for high income earners to quarantine profits at a lesser tax rate. And the third is the financial stability and the debt structuring around it. If you do it well, it's a great way to be able to boost up and build a much larger portfolio, utilizing financing mechanisms around it. So they're your three most common factors and reasons as to why we do a trust, and the pros of it. The cons on the other side, to get in there early, obviously it costs a bit to establish. You're looking at anywhere between a $3,000 and $4,000 fee. Your running costs will range between $1,000 to $2,000 a year. And it's more complex than doing your personal return. You've got to do a set of accounts and a tax return for it, some letters that are required from an accountant, and from a lending perspective, there might be a little bit more criteria that's involved, such as sign-offs or independent legal or financial advice, very common for people investing in structure. So they're typically your pros and cons, with the last one on the con side being some prolonged costs around land tax on a state-by-state basis. And hence the reason why trusts are really good to use later on in some circumstances or earlier on, depending on which state and what asset you're buying.
Perfect. That was such a good, it's like you practiced that before.
Wonderful.
That was good. That was an absolute perfect primer. So just on the land tax stuff, right? So one of the considerations that people need to think about when they're thinking about investing in trusts is the fact that you can cross-contaminate trusts with different land tax considerations, right? So we've talked about it before in previous episodes where one, or maybe you could clarify a point of view on this, is the best way to manage land tax in trusts to make sure that you have different trusts per state? Or like, would you separate things out like that? So you don't have one trust that buys a property in New South Wales and also WA? Like, would you think about that from a kind of land tax management perspective? How do you think about that?
Yeah, no, that's not really the major land tax management technique that we use. You've got to look at the state's criteria. So Queensland's a really good example of this. They give a brand new threshold per entity. So a great way to kind of kick the land tax cost down the road in Queensland, for argument's sake, is to have a brand new entity.
That.
No, that was them trying to bring in land tax consecutively across other states. So they were going to tax you in Queensland based on the land values you held around the country. But if you've got a trust number one with property number one in there, and you go then buy property number two in trust number one, the chances are you'll be paying land tax for those two properties in trust number one. A great way to kind of kick that land tax bill down the road is to have property one and property two in trust one and trust two respectively, because they're not grouped. You have a separate corporate trustee, so they're two standalone separate entities. I've done the pricing mechanism on that, and it's actually cheaper long term to have two separate trusts running two properties in Queensland, because the land tax bill is actually worth more than the compliance fee of the trust. So that's a really big win. And the same goes for WA and other states as well. Where the negative is places like New South Wales, where trusts do not receive a land tax threshold at all. And people pay land tax from $1. So I generally try to encourage clients to, utilise your land tax threshold individually in New South Wales, and then all bets are off. You can go into a trust, because that will save someone about $16,000 a year in land tax, which is a lot of money when you take that over 10 and 20 years of owning a property. But in New South Wales, as most people know, generally one, maybe two properties, but most of the cases one gets you over the land tax threshold anyways. So you've got to make sure you're factoring that cost, that subsidiary cost, which is a state-based tax, which not many people talk about, into your overall feasibility to ensure, have I got the right structure that matches the right property, which is going to get me to where I want to be in the end.
And that those land tax costs, as we talk about, the from the debt siloing or the debt extension or the debt kind of management benefits that you can get from trusts, does the land tax cost come into the profitability factor of that?
Absolutely, it does. Yeah, it does. So it's one of those costs you do need to make sure that you're adding into your calculation. For places like Victoria, Goose and Gabi, land tax is kind of on the cards for everybody. So a lot of people are paying land tax regardless, and trust a slight surcharge compared to an individual. But what I'm seeing, a lot of people counteract that because they're wanting to go into Victoria for that high growth environment that they see. As we know, Victoria's got this beautiful now concept called the small subsidiary dwelling, or otherwise known as a granny flat. And I'm seeing so many people now buying properties and getting these small subsidiary dwellings on it straight away. So they're improving their income position, no additional land tax because it's still under one title, and they're in an area where there's potentially some really good growth factors to come. Yeah,
nice. Now, what are some of the types of trusts that people might want to consider? Because there's unit trust, discretionary trust. What are the primary trusts? There's also bear trusts, for example, for super. Yep. So what are the types of trusts people should be considering, and why?
So primary trust, if you're looking at purely for yourself, would be discretionary trust, or otherwise known as a family trust. A great mechanism to build wealth for yourself and the beneficiaries that you wish it, to go to in the future. Unit trusts, or otherwise known as fixed trusts, they're really good for two separate parties coming together. It's a fixed level of ownership in that trust, and potentially based upon the unit holders, they get some discounts like 50% CGT discounts. But it's a great way for two parties to come together, enter into a transaction. Each party gets their income and are responsible for their own tax consequences. So really good for two parties. Discretionary trust is your family unit. And then you've got things like the bear trusts, which are specifically for self-managed super funds, Goose and Gabi. And that is in relation to a concept called limited recourse borrowing, which is a very special lending mechanism to buy and borrow for investments inside self-managed super. So typically a lot of people won't really need to worry about a bear trust, not unless they're investing in superannuation.
Talk to us about lending. I know that you're not a mortgage broker or whatever, but obviously you understand how this stuff works. Talk to us a little bit about lending in SMSFs, because that's not really based on your income, is it? Like, how do they calculate the borrowing capacity of a self-managed super fund?
Yeah, so it's all based upon the contributions, which are concessional contributions that go into the fund. And that's what your employer's putting in, or you might be doing some salary sacrificing. Limit's about $30,000 per year per member. So if you've got, say, for instance, two members in a fund, could be partners for argument's sake, that means you've got potential borrowing capacity of $60,000 per year. They also look at the assets return as well, the rental income. So what a lot of people have done, Goose, and this is not really talked about, but for argument's sake, you might have, husband and wife or partners and two adult children. A way that they're boosting up the borrowing capacity in a self-managed super fund is having four members contributing into that fund, which is giving the fund substantially more borrowing capacity. Yes, there's more capital in there because you've got four members' balances. And that's a great way that, that four people have been able to share based on their members' balance, the profit of a much larger investment that otherwise, for argument's sake, mum and dad couldn't have done on their own. So borrowing capacity is based on concessional contributions and also the return on the asset. And that now there are some policies that from lenders that will look at your ability to do after-tax contributions, but that will need to be accompanied by a letter from the accountant saying that the client's capacity allows them to do after-tax contributions to a certain sum, and that could assist in help boosting the borrowing capacity or helping getting a property over the line. So there is a lot of strategic elements involved when lending in super. It's not just a one-size-fits-all. And your broker does become your best friend, and they need to be thinking strategically, not just looking at what's in front of them.
Yeah, it's super interesting. I actually have been hearing about more and more people doing the kind of combined family SMSFs for exactly the purpose that you had just outlined. You're maximizing, you're pooling your capital, because a lot of people maybe have lower super balances or whatever, not substantial enough to make it make sense to start building a property portfolio. Plus, then you got the borrowing capacity consideration. So I've actually heard more and more recently about people doing that. One of the questions I've got about that though is how do they? So you get access to your super once you reach retirement age, and if you are investing, say, with your parents, let's say it's a family, all right, and you've got mum and dad and two kids, and they all pool together. does the ability to withdraw the capital from the SMSF, like if it's combined super, who's that based on? Is it like the oldest individual? So it's like if I'm 25 and my dad's 70, right? But then all of a sudden we can access the super. Like, how does that work with people with different ages with one super account?
Yeah, well, don't, if you're 25 years old, don't run out and just get into a super fund with your dad who's 70 to get your money out. It's not going to happen. It is based upon the members in the fund are under their own rules. So you've got a pool, a members balance inside the self-managed super fund, very similar to when you're in Host Plus or when you're in Australian Super. You are a member of a much larger fund with hundreds of thousands, if not millions of people in there, and you have a members balance which you can withdraw when you at pension phase. The challenge is that liquidity becomes a major issue when you've got two different age brackets, one retiring and one still growing. If all your wealth is locked in the bricks and mortar of the home and you have to withdraw a certain percentage to meet the pension entitlements, the challenge does become that the cash flow of the investment doesn't suffice or doesn't meet the withdrawal that's required. So you might have to do $30,000 a year as pension withdrawal, but the property might be only returning 20. The challenge then is going to be the concessional contributions of the other members might have to facilitate that. Or what I do see with many clients is that come super, come pension phase for some members, they do sell down the asset, which is not necessarily a bad thing, because we look at property in most circumstances, especially in the residential sector, as very much a tool for growth. And when you have that growth and when you do reach a certain stage in life, it's actually not a bad thing to sell and to look at maybe other investments which are better tuned for what you're after at retirement, which could be cash flow, or you could be more comfortable sitting on cash at bank and in 3 or 4% interest. You might want to look at shares at that time. So at your life or at a certain stage, there are certain assets that make sense for you, and not all assets make sense for everyone at the same time. Different age brackets, different stages of your life will probably have better assets that suit you at that time. And that's where, people like yourselves or financial planners can kind of match that asset to your circumstances.
Yeah, we're actually quite big advocates of making sure that you understand what types of assets you need to satisfy the different aspects of what you're trying to achieve for financial freedom. Like residential real estate in Australia is by far and away the best risk-adjusted return asset that I've seen on planet Earth, right? It's awesome. And you can build significant wealth in residential real estate in Australia. But the liquidity sucks, so you get to a point where you need to either be able to, in a very general sense, you either need to be able to withdraw the equity out using borrowing to get access to that capital to be able to spend, or you're going to have to sell the assets. And then do you want to keep it in cash, or should you have a portion of your assets in more liquid stuff? So we're big advocates of that. Property is the best asset, but it's not the only asset. And you actually do want to make sure that you've got a balanced point of view to make sure you can satisfy all of the needs of what really is the goal is financial freedom. So I want to ask a little bit more about some super stuff. So the election's coming up, and one of the proposed policies from the current government is unrealized capital gains tax in self-managed super funds.
Yeah.
What the F? What do you think?
Yeah, I'm surprised that this has come up and so close to an election. And Bill Shorten tried to touch this, and obviously that was when Scott Morrison was elected in at that time. But unrealized capital gain tax is not new. It's been around for a while, and anyone who knows global economics knows that California's had an unrealized capital gain tax for some time, and that's the reason why there's been an exodus for many big business owners, and they've all gone to Texas or gone to Florida, where they're very much more pro-business and less tax, less regulation. So to have this unrealized capital gain tax mechanism being put in place by Albanese, and his comments saying that it's only going to affect the very small few, the very small 0.5% of the population that have it. Well, yes, that's looking at today. But superannuation for those people who are retiring, where that will affect them, probably weren't in the super system for a very long time, where the majority of us have been in the super system our entire working lives. And if we do it right, $2 million is not a very hard number to get to if you invest your super the right way, whether it's with leverage or without. So I actually look at it as a negative, because what it's going to be is a deterrent, especially for many people who want to focus on super and build up super in a very, very tax incentivized space. Then you're kind of stripping that away from them, and they'll look elsewhere to do other things. Do I think he will try to do it if he wins? Absolutely. Do I think it's going to be something that's going to stick around for a long time? Absolutely not, because the people will react with their hands and feet and start to move things away from super, and it will be in other assets where it might not be as productive for the government or for other certain goods or services that super's invested into. It's a shocker. And it doesn't promote what super's there to do, which is to build wealth for your retirement, to take the pressure off the government so they're not having to look after you in your older age. I don't think it's going to stick around for a very long time.
Yeah, so exactly. The whole reason I have super is because the government can't afford the pension scheme. They could, it's basically a Ponzi scheme. We have an aging population. You need more young people to be able to fund all the old people. That's not happening. So then they said, okay, we're going to put in this system where it's mandatory for you to have super, right? You can't not have super. You can't opt out and say, actually, I'd just rather have the money. Can I just invest it myself? So you're forced to have super. And then they're going to say, okay, if we're going to force you to do this thing, and by the way, if you do well at it, we're going to tax you on the unrealized capital gains. It's mad and
crazy.
It's completely nonsensical. It's completely counterproductive to the whole, because they should actually be encouraging people to make as much money as possible in their super, so they have the least possible amount of financial obligation for pensions in the future as they can. So, but does that fundamentally, obviously it depends on whether or not the policy gets put in place, but that could fundamentally change even the idea of wanting to invest in property in your SMSF, because it's not that hard to get to $3 million if you're investing in property using leverage, and particularly if you maximize your contributions to maximize the tax benefit. It's actually not that hard to get to $3 million, over if you're a youngish person or whatever. But that completely changes that, because a lot of people think about it and go, well, I can make voluntary additional super contributions for the tax benefits and all of that kind of stuff, and really maximize that. But you're massively disincentivized to do that. So does that change your point of view? If that came into play, would that change your point of view on investing in super?
Yeah, well, I've been now in the industry for such a long time. I've seen policies come in and go very quickly. And the pub test actually really does matter, because in the end, the population votes with their feet. So while I think if he gets in, he'll try to push it through, and there'll be some argy-bargy in the upper and lower house about it, but he does push it through. They probably won't win another election. Maybe Liberal, if they do win or do lose on the next election, whoever's going to be running, they're going to be saying, well, we're going to take it and scrap it away. I've seen it now with the stage 3 tax cuts, which impacted a lot of Australians more than we all think. It was never going to be touched. And then all of a sudden, within the first year of the Labor term, the stage 3 tax cuts were pretty much abandoned, which would have substantially assisted the economy and many Australian taxpayers through bracket creep. As we all earn more, we all start to pay more tax and go into a new bracket. And a lot of people who may have not have benefited from it 5 years ago would have benefited from it today. I'm actually encouraging people to wipe out the noise, Goose, very openly. And I'm saying super is still one of the best mechanisms to create wealth. 15% tax on earnings, 10% tax rate on capital gains if you hold the asset for longer than 12 months. Unbelievable in terms of being able to transact on property. So the mindset still for me, and I'm trying to encourage many clients from a tax point of view and from a wealth creation point of view, still look at super as a great mechanism for building wealth. Because when you do convert, even if they do have that unrealized capital gain tax sticking around for a lot longer than we all wish, when you do convert that to pension phase, you probably might see yourself still far better ahead than having a huge portion of wealth outside of super, where you're going to be paying tax to the day you die anyways. So having a balance of both.
How do you think about the opportunity cost, though? Because you can't actually tap into any of that. So let's say, yes. So what you just said there is, if you hold the asset for longer than 12 months, you only pay 10% CGT. Now, if you're not in super and you hold the asset for longer than 12 months, you're probably going to pay 22.5% CGT, basically, right? So, okay, let's just round figure, say you pay half the amount of CGT. Cool.
Yep.
But you if you buy a property in your super, you can't leverage the equity out of one property to buy another one. Okay. So you can buy one property, it can grow, you can sell it. So you actually fundamentally have to go slower. Plus, you can't actually access any of that capital until you're at, whatever age. So how do you rationalize the opportunity cost of the fact that your capital, the oscillation and the vibration and the momentum of your capital is necessarily significantly slower? I would argue it's probably more than 50% slower, the velocity of your capital in your SMSF. So you may pay half as much tax, but the velocity of your capital is probably more than twice as slow. And so doesn't that actually create net negative opportunity cost overall versus if you intelligently manage trust and intelligently manage profit distribution amongst different entities and stuff outside of super? Like, I don't personally see the incentive.
Well, I'm going to challenge you. You challenged me before, so
Good.
I'm going to challenge you on this one. So I like this. So I think I'm a big believer of having your cake and eating it too. We know that there's all these benefits that you can get outside super through extraction of equity, trust distributions, beneficiaries, lower tax rates, as you said. I actually don't believe that money in super works slower. I actually think it can work a lot faster because your capital can accrue quicker if you buy the right asset and you look at it from a transactional basis. I've seen, and believe it or not, it's you guys as well who are part of that. I've seen you guys buy properties for clients that doubled in 12 to 18 months when you invest in. And a lot of people, if they've invested during that period, especially in WA and some parts of the northern parts of Queensland, especially the Townsville, Mackay and Cairns areas, those properties have gone up 50, 60, 70% in the space of 2 years. Now, you exited that property, you pay less tax because it's now only 10%. You've held it longer than 12 months. You now have a larger pool of capital, Goose, to be able to invest into not just one property, but potentially two properties. Because from the sky, you've now received profit. Yes, there's a bit of tax you've paid, but only 10%, peanuts, 10,000 for every 100,000 of profit. You now have more capital split across two properties where the denominator is increasing. And if you can replicate somewhat similar and may not be at the velocity that you had in the past because it was a bit of a weird time in the property market, all of a sudden now you've got a higher amount of denominated investment in the market moving at potentially the same rate with a higher level of gross return. So you can be active in your super fund as hard and as fast as you can be active outside super, and your capital can be retained more inside super through lesser tax. So, and again, if you are quick and nimble, and I've seen some clients do this, buying very rundown properties in super, quickly using the super fund's money to renovate it, 20, 30 grand, and selling it within inside 12 months, where otherwise would have had to pay tax at maybe 47%. Now they're only paying tax in super at 15%. So it's not a 10 or 20% gain anymore. It's much more than that. It's nearly 30% gain. So your level of action, and like anyone who's a property investor, more action you take, more actively that you're involved in your portfolio, you can generate really good returns and then start to move that on. So I'm seeing very successful people in Super Goose transacting multiple times in the space of 2 or 3 years, having 2 or 3 properties and moving that and making money. And in the end, nothing different to shares. They're just using property as a transactional based tool of generating wealth, as they do with shares, where they're in and out. It's just not as quick, but sometimes if you're smart, the returns can be much more.
I hear you, and I understand, and I understand, and I kind of broadly agree. Like I don't think it's like a bad strategy. So I'm not trying to take a position that I think investing in super is not a good thing to do. I think it is. I think it could be a fantastic thing to do. But just fundamentally, like if we just take a point of view of like, let's say you buy a $500,000 property, and let's say it grows, just for the point of the discussion, by $150,000 a year. So 3 years later, it's worth $950,000. And we're going to use general numbers here just to illustrate the point. If it's outside your super, it can go up by 150 grand. You can leverage 150 grand of equity out of it, go buy another property in the first year, right? And then the next year, you can take 150 grand out and go buy another property. Now you've got 3 properties. The first property might have gone up by 150 grand as well. You could take that out and then you've got a 4th property, then the second. So by the time you get to the end of the 3 years, you could have 5 properties or 6 properties, versus in your super, you get to the end of the 3 years, and you sell it and you take the 450 grand, and then you go buy 2 more properties. And so you've got, in year 4, you've got 2 properties in your super, or you've got 6 properties outside your super. And that's sort of what I mean by the velocity of it. Now, we could wax lyrical on this all day. I don't think there's a right or a wrong, but I think I think it's an interesting consideration. I guess my general point of view is I don't particularly agree with super. I don't agree with anyone. I don't agree with anyone telling you how you have to spend your money. So I guess my point of view is super's there and we have it. So therefore use it intelligently.
And I think that's the moral of the story. And you're right, your processes outside super are much more efficient, no doubt about it. But there's no point trying to beat down the beast. The beast is there and it's not going away. Yeah. So tame it, give it some really good food, and it will actually maybe like you in the long term. So that's the way I kind of, reiterate that to all clients. Don't try to, beat it, feed it, look after it, and it'll look after you in the long run. So look at super. Many people that think it's the biggest waste of time, I really try to change that rhetoric with them and say, guys, it's not a waste of time. What you're doing with it is a waste of time. And that's where you now need to be more actively involved and make it work for you. And that's where self-managed super funds come into play. But you do need a really good balance of, say, circa 200 to 250 plus. You want to make sure still the quality of asset is there. You just don't want to be buying something for the sake of buying. You want to make sure that it has the ability to grow and you can do things with it in the future.
Can I ask you? It's good. I'm going to challenge you again. I think this is good, right? But why 250? And the reason I'll use an example. So we actually had a client who actually did the whole kind of family pooling their SMSF thing together. They had about 150 grand. Now, so let me zoom out. I think the reason you're saying you should have 250 grand is because for most people, they lack the tools and intelligence. When I say intelligence, I mean data, research, everything, to make sure they're buying the right assets, right? So you sort of got to make sure you buy a high quality asset, a good location, that's low risk, and all these kind of things. But I know someone one of our clients who had $150,000 super balance as a family combined super. They bought a good property that using our system, and they doubled their money in 12 months. They got 100% return on invested capital in 12 months. So is there a reason that you say 250? Like if someone has the right system or the right support of the right partner, could 150 work? Or is there where's the kind of balance? Like why did you say 250?
Yeah, so I said 200 to 250 because I always like to look at the cost versus benefit analysis. So the cost of running a superannuation fund at that circa 200 to 250 is very much in line with what your industry fund would be charging you as far as admin fees are concerned. That's an accountant versus industry fund. Further, you're right, quality of asset comes into play. You want people to be able to have a really good quality of asset because the deposit requirements in superannuation are much more higher than, say, investing inside a trust or your personal name. So more deposit means obviously less potentially loan you take, but less purchase price that you can activate on. But you're right, I have established funds for people less than that with a very solid plan. They've had a statement of advice being produced. They know what they're doing, and it's a great tool for them to be able to accelerate their superannuation portfolio and funds much quicker. So again, there's no one size fits all, but many professionals should be encouraging people to get to that level first. You just don't want people going and buying something for the sake of it to tell their friends at a barbecue they've got a property. It still needs to have value.
Yeah, you know what? I agree with you, because if you take the the middle of the bell curve and you look at the average person, the average property investor is not successful. The average property investor doesn't get it right. They buy properties that typically don't perform that well over the long term. They're broadly fine, and so if by having a lower balance in their SMSF, they're kind of forced to only consider assets within a certain price range, the probability of them making an incorrect choice increases rather than decreases. And so if you are going to have a lower balance, say 100, 150, 175, you have to actually make sure you've got a really robust plan, a really robust strategy to make sure you're buying the right assets. So yeah, I think from a risk
there's got to be a very, very strategic plan behind it. And I've probably seen very openly, Goose, in the last maybe 6 to 12 months as rates have kind of hit their peaks, more super funds being established than I've ever seen. And that's because a lot of people are still seeing value in the property market. They can't access the funding because of borrowing capacity through the limitations that are imposed by APRA and all the different prudential regulation authorities that are out there. But that's been a tool and a mechanism for them to continue their journey. And I've seen some really good growth. I've seen some clients buy 12 months ago in Victoria, And, they've made about 25% return, even though the numbers aren't specifically showing that just yet on all the diagrams and all the beautiful Gantt charts that we all get to see. But for many people with boots on the ground there, there's huge amounts of volume of people at open homes, and we'll start to see that data transform over the next 12 months as a lot of these settlement data come through. But yeah, that's been a really good window of opportunity for people to explore through self-managed super fund to continue their buying journey and, be honest, outpacing some of the industry returns they've received over the last 10 years.
100%. I think that's actually one of the biggest opportunities. As I mentioned, I'm not an advocate of super, but we have it, so we've got to do something with it. And you look at the industry super funds and whatever, and they're getting whatever between 7 and 10% a year. And it's the question you ask yourself is, can you beat that with property? Almost certainly, if you use leverage. And so there's a question actually here in the chat from Dan Dodds. He said, I get the impression that SMSF is not great for gaining financial freedom at an earlier age than the mandatory superannuation retirement age. Well, I mean, the reality of the situation is you can't access your super until you reach retirement age anyway. But what you actually want to think about is, how do you maximize the returns? How do you actually set yourself up for the maximum benefit when you get to that age? And your options are keep it in an industry super fund, or take matters into your own hands, but make sure you're doing that intelligently. Because I also know people who have gotten in self-managed super funds, decided they're going to chuck it all into shares, had no idea what they were doing, and basically lost everything. And so I've seen people completely destroy their super as well. So you have to be, like, personal responsibility is a very, very big thing. It's amazing and it's powerful, but it's also very real. You have the opportunity to make money and you have the opportunity to lose money. And if you don't know what you're doing, you're probably better off just leaving it alone, unless you've got a good partner or a good strategy or a good sound backing. I want to shift gears a little bit out of super. I want to go back to trusts, because I want to talk about profit distributions and tax loss distributions. Two things I really am interested in. So let's say someone's using a family trust, a discretionary trust, family trust, and they can have multiple beneficiaries on that trust. So they could have, let's say that they're parents with 2 kids. They could have their kids on as beneficiaries on the trust. They could also have other trusts or other companies as beneficiaries on that trust. And so I want to ask you about profit distribution, but also CGT distribution. So if let's say that Gabby and I have got 2 kids, which we don't, but let's say we did, and they were beneficiaries on our trust, and we sold a property. Could we distribute the CGT across our kids as well, therefore maximizing our tax benefit? But then also, if we had a loss in another trust, could we distribute the profits to that other trust and effectively mitigate CGT?
Perfect. Yeah, 100%. So number one, your trust deed will determine where the money can go, and most trust deeds will allow you to distribute that money to immediate family. That's mums and dads, aunties and uncles, cousins, children. It must be above the age of 18, must be an Australian resident, because a lot of trusts will have foreign beneficiary exclusions on there, which stops them from having to pay double land tax and double stamp duty. So that's very important to note. But you're right, if there's a capital gain or an income that's been generated from the trust, you've got the opportunity, pending on the deed, to be able to distribute to the beneficiaries, children above the age of 18, other companies and other trusts. So the flexibility of being able to minimise tax is there. And I've utilised that flexibility many times in my own personal portfolio. I've had legacy trusts I've had for a number of years, investing in properties. I've had new properties being purchased where those properties were negatively geared, and I was using the profits of Trust 1 and 2 and 3 to be able to fund the losses of Trusts 4, 5 and 6. So essentially there was no tax obligation I needed to pay, and one hand was washing the other, which was great for my borrowing and also great for my tax. So my portfolio A, Tier 1, was paying for my portfolio B, Tier 2. Depending on your circumstances, and again, a lot of my high income earners, Goose and Gabi, use this, is that they're already earning their 300-400 grand a year, which is fantastic. They might have 2 children, which unfortunately not the age of 18 yet. They might be 14 and 16. We then distribute to a corporate beneficiary, otherwise known as a bucket company or a profit holding entity. So we throw all of our profit in there, and the tax is at a flat 30%. Strategically, we then structure that corporate beneficiary to have a shareholding with a trust attached to it. When those children turn the age of 18, and they might be at university or, might be doing some TAFE qualifications or apprenticeships, lower incomes, we then get the money out of that corporate beneficiary by way of a dividend, send it to now the children who are above the age of 18, and I'm getting some of that tax back that I've paid at 30% through what they call franking credit refunds. So the beauty of trust is you've got the opportunity to park profits.
Slow down. So
I'm sorry, I get so excited about this
No.
stuff.
I just want to slow down on that point. I just want to double tap on that point. So let's say that you've got two kids, but they're 10 years old, right? 10 and 12.
Yep.
Right? So they're not 18. So you can't distribute the profits to them directly and claim. So you can have a bucket company where you distribute the profits to, okay, and then that bucket company will pay the tax rate of 30% on those profits. Yep. So you'll pay the tax, but you'll accrue franking credits.
Yep.
Which then at a later date, you can distribute the profits back out to your kids, for example, once they turn 18, and you can claim back that 30% tax in franking credits because you paid as dividends. So you pay the 30% tax, but then later on you just get all the tax back through franking credit distributions. That's
it. So effective tax rate in some of the circumstances for my clients has been 0. I love it. This is now the fun stuff. This is real accounting that I enjoy. So I'm parking profits to strategically use them at a later date. And if I do it well, I can get those profits out with 0 top-up tax or a tax refund through the franking credit system, meaning that these two high income earners who would have paid tax at 47%, if it was owned in their own names, have paid tax today at 30%, to get that potential 30% back when more beneficiaries come into play over the age of 18. So it's a really good opportunity if you're using structure the right way. That's where you really can minimize tax. Now, many people say, well, Jeremy, I don't want to just leave cash in a bucket company forever. What can I do? Well, that bucket company is also and can be used as an investment entity. So many of my clients will use that cash and may invest it in, Vanguard, or may buy shares. They may lend that money out if they need to at an interest rate. Their goal is to make that cash that they've stashed in there at a lower tax rate move a lot faster for them. Because again, the goal is for every dollar that goes in there, they're retaining 70 cents, Goose and Gabi, as opposed to if they left it in their own name, they're only retaining, say, 52, 53 cents. Yeah. So they've got more capital to be invested somewhere else to generate returns while they're waiting to get that money out later on in the future with a very good tax incentive behind it.
So you could take let's just say you've got several $100,000 sitting in that bucket company. You could then lend that to another investment entity. So you could have another property investment trust that you've got set up. You could lend the capital from the bucket company to the investment company. Then, because then the loan repayment at a later date, so you can put that money to work. And then the loan repayment at a later date is obviously non-tax events, right? Because you're just repaying the loan. You could have a very low interest rate on it to kind of minimize kind of complexity.
Well, it's got to be commercial. So it's called a deed of loan, a proper loan contract that you have, because that entity is a separate legal entity. But essentially, you're paying interest to yourself as opposed to interest to the bank.
Deductible anyway, wouldn't it?
Interest is accessible in the company and deductible in the trust, and then it goes back and forth like a bit of a yo-yo.
Even if you establish it, like you went, okay, we're going to charge the RBA cash rate plus 2%, right, as an interest rate, right? So you could lend the money out. Let's say you've got $200,000 in your bucket company. You lend that to another company. You're going to use that as a deposit for a property. You're charging whatever 4% interest on it. But then that's going to be tax deductible in the property investment company trust anyway. So that then becomes a deduction.
Correct. And it becomes assessable income in the company, all under commercial loan terms. And then we start to move profits around our structure in the most tax efficient manner. So that is real property structuring. That is real tax structuring as we start to really explode our property portfolio in the future. Now, again, it's not an elaborate structure. There's no hidden gimmicks behind it. It's been out there for a while. It's just when you're ready and how good your accountant is to execute on it. and making sure that the vision is there. But that is definitely a structure for many high income individuals. I get really excited because I know the tens of thousands of dollars that I've saved, if not hundreds of grand, for many, many individual clients who have adopted this over a number of years. And I know the impact of having more after-tax amount of cash that has gone to buy more investments, and that alone has helped their portfolio grow by millions. So you've got to have those really 3 things or 4 things wrapped up: a really intelligent lending strategy, a really intelligent asset acquisition strategy, a really intelligent tax structuring strategy, which leads to overall the 4th being a big circle of a wealth strategy. So you get those 4 things all moving in your journey. That's where you're going to have some really good after-tax gains, which then support more wealth on top.
Yeah.
The negative though of trust, and again, not many people talk about it in many of the videos because it doesn't get the clickbait, is that trust, when they do have losses and you don't have any other entities that can absorb those losses, are carried forward. So as far as negative gearing is concerned, when we've got it in our own name, we get our marginal tax rate back as a cash refund. But when it's in a structure like a trust, those losses are carried forward and they are utilised against future income generating years. So they're not lost in the ether. They don't run away from you. They are carried forward. And then when there's profits from that entity or other entities later on in the future that have the ability to distribute to it, that's when those losses can be utilised, essentially saving the tax at that time.
Yeah, it's not like it's lost. It just gets captured and kind of saved for later. So yeah, you don't get to claim it necessarily in the current financial year, but even if you carry forward those losses for a few years and then claim them against a CGT event, for example, then you still get to claim those benefits at a later date, right?
Absolutely.
Final question. This is a quirky one, right? And actually, maybe not a final question because Gabi, I know I've just hogged the mic here, so maybe you've got a few questions you want to ask.
I'm enjoying it. Go. No, you go.
Is there any scope to leverage things like management or consulting fees between entities in any meaningful way to bolster the income position of an entity to support a lending or a profit strategy?
Yeah, it's a very cheeky way of trying to bypass the banking system to show profitability in the entity. I'll put the diplomatic hat on and say that everything always needs to be commercial and arm's length in nature. But what I have seen some clients do is that, and it's legitimate, is that they've organised rental arrangement between a company that they control and an investment trust that they own. And there's a rental arrangement commercial between both entities showing positive gearing, and then they've gone and used that property for room sharing or Airbnb in the company. So just to put that in perspective, trust owns the property, company has been established, owned by the same person. They're going to do some room sharing. The company rents the property from the trust at a very elevated amount. They've deemed it to be commercial, shows positive gearing in the trust, but then they've gone and used that company for room rental. And they're getting a certain amount of profit to be taxed at a lower percentage and also showing better borrowing capacity. So that comes through a lot of the vision that you'll have with your broker. But as far as just at the end of the financial year, the accountant swapping around money to show it as management fees, I would say be very careful. Banks are still quite smart, and they'll look through that to see, well, where's the money being originated from, and then track it back to get the true result.
And also, I think, I guess to some degree, shuffling deck chairs around, doesn't really, at the end of the day, let's say you've got 4 different trusts, and let's say one of them's wildly profitable and, one of them's, and 2 of them are break even and one of them's running at a bit of a loss. And then you want to go and get some more lending, you're still going to be assessed on all of those factors combined, right? So you can move stuff around, but it's not really going to shift your total borrowing position, is it?
No, it won't from a management fee perspective, but on a distribution perspective, if you've got 2 trusts or 1 trust that's positive, 2 that's neutral, and 1 that's negative, that 1 trust that is positive, a family trust distribution can be made to the trust that's a loss. Therefore, now you've got all your trusts which are positive, which means that there's a potential negation for all those 4 entities.
As long as you've set up the deed so that you can do that, right?
Absolutely, absolutely. So that's what you need to look at. It's where does things sit inside your overall structure and property portfolio, and that's what I've done. As I said before, I've had Trust 1, 2, 3, been able to distribute to Trust 4, 5, 6, even though Trust 4, 5, 6 were a loss at that time, and that's given me the opportunity to negate all the debt in those potentially 6 trusts at the time. So you've got to make sure that you've got a vision that you're expanding out. And lending, we all know as a successful property investor, it's not about sometimes always the best properties, but it's sometimes finding the avenue to buy the best properties. And that comes through lending. If we can borrow more, it's going to give us more opportunity to seek more assets for more wealth creation. So know your finance and know it well. And that's going to give you every opportunity to be able to buy the successful and the right assets.
That's also why like being tax efficient and tax smart is very, very important, because, if you've got profits and you're paying 30, 40% of tax on those profits, or you could pay none and you could redistribute those profits between different entities, and you get smarter about that, that's going to maximize your ability to continue to do that. It's going to maximize your ability to continue to borrow, invest, continue to grow. So those little kind of nuances about how you do this really compound up over time to make very large impacts on your portfolio overall. So yeah, I think that's awesome. Is there anything you think we should have covered that we didn't cover today, Jeremy?
I think probably one of the main things is I like to get this across to everybody. Structure is only as good as your original intention. So you need to make sure that you've got a business plan that's matching what the asset that you're buying, that's matching the outcome that you're after. So many people, I want to go develop property straight away, and they go get themselves a company set up, get halfway through, and they want to keep it. Or people want to buy an investment property, buy it in a trust, and then, I want to knock it down, I want to develop it, I want to sell it straight away, and then they start to have a whinge about GST on the margin scheme and other things. So know what your purpose is. Treat every property that you buy like a business. What is my business plan? How can I improve the value? Don't stop improving on your current property portfolio. Some people get stuck, Goose and Gabi, and they throw their hands up in the air and say, I'm out. That's not what a successful property investor does. A successful property investor will look at their existing portfolio and find small things that they can do to improve the value, whether it's from a capital or rental perspective, and know what type of asset you need at certain stages in your life and in your journey. Again, matching that to your structure. I'll relate it back to what I see you guys do in your property plans. I generally see the first couple will be very foundational in nature, and then all of a sudden you start to throw these. We're buying this property with a granny flat. We're going to buy that property with subdivision potential. We're going to look to sell down property 1 or property 2 by year 6 or 7. And we're going to enter into property number 7 or number 8 using this. I think that is so good for people to kind of Gantt chart out where they want to be at a specific time, and try to make sure that, again, the business plan of the property that they're buying matches where they want it to be. I feel that that's probably the biggest thing that's lacking in many people's portfolio, is they're just buying for the sake of buying without a purpose. And I'm not talking about goals. We all know about goals, and we all know about, vision boards and all those things, but it's actually creating the business plan on a timeline so the asset can be effectively matched to it. And that's the biggest thing that's missing in most people's property portfolios today.
100%. That's why we built the portfolio growth plan, so we could do exactly that. So you could actually go, okay, so yeah, cool. Like, we know what our goal is, financial freedom. Like, let's get the number, let's get clear, let's get all that. But like, how do you get there? Like, and how does one property ladder into another property? And to your point, like, when does it make sense to sell down some assets and redistribute profits? And because everyone's going to find an edge, and it's not about just getting to that edge and then stopping. It's get back into that edge and asking, well, where do you go from here? I think you're right that most people, the fundamental reason most people don't achieve the success they want in property is because they don't have a plan. They don't understand the right sequencing of properties. They don't understand how to use the theory of constraints to understand where they're going to find the edges in their portfolio. They don't understand that, maybe holding properties forever is not going to be the answer. Maybe holding properties, selling them, and you've done it yourself in your own portfolio. Use it, it serves a purpose, you sell it down, you liquidate it, you unlock, you release debt, you release profits, you release whatever, you release an asset or a resource in your portfolio so that you can reallocate those resources to continue to grow your portfolio. And, in the first instance, maybe you can get from 1 to 3 properties, and then you go, okay, now you've got to sell down 1 property, and then you go buy 2 more. So then you go from 3 to 5, and then you sell down 1 property and you go from 5 to 7. And, it's a process that you need to continue to work through. And you need to make sure that you've got a really clear plan to be able to follow. Because otherwise, to your point, you just end up buying properties and hoping for the best, basically.
That's it. And that's the biggest thing that's lacking, I suppose, in the property industry at the moment. It's the other side of the transaction, which is that sell side. When to sell. No one wants to kind of pull the trigger on it. And you know, I have chats with clients all the time and really look at, okay, guys, your property at the moment's worth $1.2 million, renting for $650 per week. Would you be buying that property today for 1.2, renting for 50? They can't extract the equity out of it, Gabi. They've got this dead amount of money, this dead amount of opportunity there. But once they realize that, okay, we sell, we pay a bit of capital, this big pot of cash now, and like for like, they're buying a far better quality property, worth more money, renting for substantially more. So the income denominator's gone up, the asset denominator's gone up, and that's all been from releasing physical cash, paying tax, and having a far better quality asset on the other side. So that's where structuring comes into play, tax minimization, because my role is when you do decide to sell, I want more of your money going to the next investment as opposed to the tax office.
Yeah. One final question. I think I've asked you this one before, actually. Small business capital gains tax exemption. Does that apply? In, you know, it's effectively if you start a company with a trust, a trustee company, or that kind of stuff, you've got a discretionary trust and a company that sits over the top of it, and you're in the business of buying real estate as an investment. If you then sell that investment, are you able to defer the capital gains if you reinvest it into it? Are you able to use the small business capital gains tax exemption rules?
Not as an entity that's an investment entity. So again, mum and dad just buying a property and renting it out. There's a lot of tests that need to be met. It needs to be active entity, physically trading. There are some circumstances where if an asset was tied with the business, so for argument's sake, it may have been farmland tied with the primary production of growing cows and selling cows, or it may have been a mechanic shop tied with the business that was sold. There are some exemptions for the active asset as part of that business. But for a majority of us being investors, no, we just pay the capital gain tax with that nice 50% discount.
Actively selling places to sleep and stuff is not officially an operating business.
Not in the eyes of the tax office. Then would be a great time if they did. We'd get 50% on 50% discounts and pay no tax. It'd be brilliant. But for majority of people investing and using property as a tool for wealth, best thing that might be applicable to us would be the 50% discount, depending on the structure we go in.
Awesome. Love it. Jeremy, thank you so much for your time. Really appreciate it. Great to see you again, as always.
Pleasure. And Gabi, next time we'll let you steal the microphone for the day.
I was a witness this week. We're all good. Thank you so much.
Awesome. Thanks, guys. And thanks for everyone who joined us live. Lots of great, I think we answered a lot of the questions that came up in the chat there. So thanks for joining us again live. Great to have you here. Great to see you. Looking forward to seeing you again next week. Jeremy, stick around for a moment after we wrap this up, just to make sure we upload correctly. Guys, we'll see you next week. Thanks very much.
Bye.